Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You are listening to Money on Tap. My name is Seth Krussman.
And I'm Ben Brayshaw.
And I'm Dan Mickelon.
Who is that guy? You say to yourself, Dan Mickelon. He's a partner with us at Brayshaw Financial Group. And Dan, it is so good to have you with us today.
Very glad to be here. Thanks, Seth.
So I like having Dan on the show, Seth. I'm sorry. I like it. Are you leaving? Are you heading out?
Are you apologizing for Dan? Did I just hear you apologize for Dan for being on the show? Dan, forgive him.
I'm not apologizing. I'm glad he's back.
Oh, I'm hoping to be the regular third wheel here.
That's what we're going to put on your desk, hoping to be third wheel here.
That's my goal. I want to be a third wheel.
Well, folks, you are no third wheel to us. We want you to be confident in that as you join us at Money on Tap today. You can call us at 855-226-8551. Folks, we have a doozy here for you today. We can't wait to jump into it. Of course, we're going to do some money in the news. We'll get to that in just a second. But this is going to be a Trump versus Biden show. That's not polarizing at all. But we're going to grab this information and take a look at market performance and election years. You know, what does the data tell us? And what are the platforms that are being proposed? And what is the potential outcomes that we have coming down the pipe? This is a Trump versus Biden show for anybody out there interested, worth your time to stick around. But before we get down that road, we're going to jump into money in the news.
Well, the first article we have today, Seth, we just did a show on the Dow. We just did a show on the pricing of the Dow, the 30 stocks of the Dow, and now we got some big shakeups in the Dow.
Ben, I gotta tell you that you say just, but it was like February.
Was it February?
Yeah.
Well, I guess it's just time flies. So what can I say? But the Dow, as we all know, is the 30 largest U.S. stocks, essentially. And they dumped some big boys out of it. They took 3 companies out of the Dow. Now, if you look back, we did a show about how GE had been removed from the Dow after, I think, over a century of being in it. But Exxon, which has been in the Dow for over a century, was just removed. Pfizer and Raytheon. And then replaced with 3 well-known companies, Salesforce, Amgen, and Honeywell.
That's interesting. They dubbed it, kind of out with the old and in with the new. It's a reshaping of the Dow 30 with some kind of more modern companies that represent the more modern economy.
I noticed, Seth, too, Dan, in the article that it said that they're actually saying this has all to do with Apple deciding to split its stock, which is really kind of a crazy thing of how they move everything around.
Tremendous effect that largest company has, doesn't it?
Yeah.
Yeah, Ford. Well, and we talked about that in the Money in the News. It was either last week or the week before, because it was news. It was Apple's 4-to-1 stock split, and it wasn't like they had never done this before. It was some, but the landscape of how that changes the weighting and the effect of an index like the Dow, it has an effect. It definitely has a significance. So when taking a look at the companies and how they balance the Dow, this is the solution that they're coming up with. And Exxon, which go back 20 years, largest company in the world at that time.
Yeah, I mean it's lost. It's had, what was it, the largest market cap? I think in history, and just lost 40% of its value this year.
Yeah. So the question is it a short-term solution to a bigger equation, or do we see Exxon come back at some point, or is this what we get to look forward to moving forward? And I would argue that tech is completely changing the landscape of everything moving forward as we see things in our economy. At the moment, tech is booming, and is it a bubble or not? I don't see how tech can be considered a bubble again when it is such a massive driver with everything that we're doing.
Yeah, it would be hard to see that change. I mean, considering the fact that just those few handful of tech companies make up 25% of the S&P 500.
Yeah. Yeah, no, that's dead on. I think the other piece of this is that, with Exxon out, Chevron, CVX is going to be the only energy real play in the Dow, which is kind of surprising. It's a big deal. I think, but Salesforce, as we all know, is a huge player in the a cloud. It's just a cloud computing company. But I think the thing about the pandemic and the thing that this move really does define is the Dow is attempting to really say, hey, this is an index that we respect as kind of what America looks like. What does the market look like for America? That kind of thinking. And with this pandemic, yeah, I do think we go back to kind of a new version of normal. And I hate to say that, but because we're such a social being that, yeah, we're going to go out to dinner. We're going to do the things that we used to do. But I do think that companies have a more remote general infrastructure than they've ever had before continuing on. Even after post-COVID, vaccine and everyone's fine and COVID will never affect you, I think we will get to something where we would have a lot of people come back to work, come back to an office, but I think there's going to be a lot of people who, just still work remotely, whether it's 3 days a week or 2 days a week or something along those lines, because it's just more effective for them and the companies, and the companies are able to save money by downsizing the amount of office space they have. I just think overall the tech is not going to completely just subside and go away or back to what it was at. It's definitely going to be enhanced.
So the three companies that are coming out, Exxon, Pfizer, and Raytheon. Pfizer Pharmaceuticals, and what does Raytheon do again? I just like the name, so I kind of just never get past it.
The aerospace and defense.
Thank you. With a name that awesome, that's what they do.
Well,
Honeywell is their replacement. I mean, they're aerospace and industrial manufacturer. So, but Raytheon's a great name.
What's interesting is, for years and years and years, the size of the economy and the best peg we had, I was just thinking, was the Dow Jones. It made up of 30 companies. And then we moved forward to the S&P 500, kind of a larger look. And then the NASDAQ came out, and that was 2,500 companies. And now when we look back at it with these changes in the Dow and understanding where the economy is, we're back in the spot where this entire economy has been driven by 6 or 7 companies.
Yeah, I mean almost every version of every index is being driven by these some level of these companies, or how they impact the smaller companies that provide, whether it's the chips for them or something along those lines.
So Pfizer getting replaced by a biopharmaceutical company, and Raytheon getting replaced by pretty much the same sector, right? So the big story there with Exxon coming out, which is the energy sector being replaced by technology, and that's one of the reasons that we really focused on that. And so that's a changing of the guard.
Yeah, I'm sure Amgen's loving it right now.
Taking a look at the stock, yes, they are. So, you guys, Warren Buffett. Can we do a money in the news without that name sliding in here? It's hard to keep him. It's hard to keep him on the sidelines, but he's here again, and he's telling us possibly one of what the article states is one of the most important notes in history of how money now works. This is an article by Tim Denning. Go ahead and give it a like or follow. We're just going to briefly touch that Warren Buffett is saying the value of money you have is changing, and that debt and what it means is fundamentally changing. What does that have? Why would Warren Buffett be changing his perspective on debt today?
Well, I think what's been puzzling to him, and he acknowledges that in the article, is that regardless of how deeper and deeper into debt we get, for the first time in history, we just resolve that issue by printing more money. And that brings into play his questions around inflation, the value of a dollar, purchasing power moving forward. We've seen him take a different tact in his investment portfolio, moving into more secure things like T-bills and gold for the first time.
Yeah, I know. I think where I'm a little surprised by this is that, and I was saying this to you guys. I mean, is this somebody who's just getting older and literally putting their money under the mattress and saying, I've made my money, I made my mistakes in financials and aero in the airlines, and just kind of bouncing back down?
Yeah, he's Warren has gone against his traditional grain over the last several years. Like you said, what is it about Warren at this point in time in his life that he is changing the cards that he has held so consistently? And it's hard to say. I mean, we could speculate on Warren, and is he just kind of run out of steam? Is he just just trying to take things off the table that traditionally would have held long term, because maybe he doesn't see himself having that timeline? I mean, as a human being, that's who he is as a human being, and that happens over time as the closer that you kind of get to exit. It's hard to say, but he's definitely doing a lot of things that he traditionally has said, don't ever do that.
Well, he makes one really good point that, I don't think anyone can deny, which is inflation. And inflation is that kind of hidden tax on your money. And that's something that he's pointing out to the average investor that, we're not really quantifying today, because as you see your portfolio rise with this market and things may be coming back together for you financially in your 401k or whatever you're investing in as a listener, we don't know how that spending power is going to change 20 or 30 years from now. And that's kind of that thing we just don't really understand, how the impact is so heavy on our investments.
Moving on. I have a love-hate relationship with some of the things that we talk about in the news. I just got to say that before we get to this article.
I definitely have a swing on this feeling here. There's a part of me that's a little maybe jealous, but the other part says totally wrong.
Why don't you tell us what are we even talking about, Ben?
Well, this gentleman, I think his name is David Hein, he's being accused of buying a Lamborghini with his company's COVID-19 relief money. I guess the guy owns a moving company with 70 employees, and looks like he bought a beautiful red Lamborghini. We got, how much did he get? Like $7 million or something like that?
I think it was $4 million.
$4 million? Yeah, it's crazy money.
Yeah, a $315,000 car, though. That's one way to stimulate the economy, I'd say.
Not the U.S. economy, though.
What does that work like when you walk into Lamborghini and you're like, yeah, that's the one I want? I mean, is that a commissionable sale? Are they a salary employee? What's the margin on one of those?
I don't know, Seth. I haven't sold a Lamborghini, nor have I been able to buy one. So we'll just leave it at that.
No comment.
You're staring at me. Listen, this is totally wrong. I mean, come on. But this wasn't the only thing he spent his money on, which is horrible, because this is just the worst. But they're saying he gave like $15,000 to his mom, and $7,000 trip here, and $4,000 trip here, and all these things are out of, I guess, financial character on some level for what his company has actually done. And or made.
Yeah, I believe it was a moving company, right? So he's the proud new owner of diamonds and jewelry and a shopping spree at Saks and a new Lamborghini.
Maybe he'll admit to have stolen those and didn't use the government's money. What's better?
You can feel free to move that my way. I'll take every little bit of that.
So that all of these things are, supposedly were bought with the PPP funds that came out, and it's interesting that this is an individual who are potentially seeing go out and buy some things for themselves personally and get called out for it. But do you remember right when the PPP was rolled out, the stimulus was rolled out, how many of these corporations and sports enterprise, like what was it, the Lakers, that they were given millions upon millions of dollars in PPP and stimulus, and people were up in arms, like, really, the Lakers need that money?
Yeah.
The Lakers?
Well, they're not the only people. I mean, there's been a bunch of companies that have paid it back because it was, they were getting so much flack for having taken it, and it's complicated. I mean, this is definitely not in the spirit of why the money was given, and who knows? Maybe he had bought it long before and he was waiting for delivery. I don't know. I don't know the background here, but I think if you're either getting a Lamborghini you already purchased or buying one after the fact, probably didn't need the money. Who knows?
Maybe this is the kind of stuff that Buffett just can't get his head around, this type of expenditure, free Lamborghinis from the government.
Yeah, right.
People, as promised, we are going to talk about two candidates, their platforms, the potential outcomes, and what has the market told us in the past. We've got a ton of data that supports your understanding what the outcomes can look like. It's a Trump versus Biden show. Don't go anywhere. Stick around. We'll be right back at Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You are listening to Money on Tap. We have had a lot of fun so far with money in the news and what's on the horizon for us here at Money on Tap is a Trump versus Biden show, and we love to take a look at all sides of the issue here. That's one of the things that we've continued to maintain from the beginning. You guys, we want to take a look at all sides of your retirement plan, and it's about three-dimensional investing. So we cannot pass up this opportunity to take a look at two different platforms, two different candidates, and what does the history tell us about presidential elections and election seasons?
Yeah, this is the stuff that gets everyone wrapped up. Like, what are the statistics? What are the odds? What is everything that I should be doing if Trump got in, Biden got in? What's the next few years look like, and how's that work? And we've got a nice list of information and things to think about. And I preface the entire show myself by saying this may not be normal, considering the fact that we're coming out of a global pandemic. So I think some of these statistics are kind of like buyer beware. Don't do anything based on these statistics, but it's really good to have some kind of general views on that. And we're going to framework the show a little bit today. One thing that I'm really excited about with Dan here today is we're going to talk a little bit about the general overview or statistics around either a re-election or an incumbent getting knocked out. What does that look like financially, traditionally? I think then we're going to jump into what does it look like with a Trump re-election or What does it look like with Biden as the incumbent gets thrown out? And then also we're just going to kind of come back on everything and really talk about, the crisis of what a disputed election might really look like, because there's so much conversation about mail-in ballots and fraud and, Hillary stating, telling Biden not to concede. I mean, there's just lots of stuff around this that's, kind of out of the spirit of how the U.S. government has, or the presidential elections have been handled for the last few hundred years. Usually there's a fair concede and there's a smooth transition of power, and what might that do to the market? So, so with that, I'm going to start off with one particular stat, and then I'm going to just hand it over to my partners here a little bit too. But when a new party comes into power, so if Biden happens to overthrow Trump, the analysts have found that the stock market gains an average of about 5% on a mid-election cycle. But when a president is reelected, the stock market has returned a little bit higher, about 6.5%, which is just an interesting comparison. And I think that's just kind of more of like feeling comfortable about more of the same. Maybe, guys? I don't know. What do you think?
Yeah, I think that's probably a big piece of it. There's always fear of change, and in this particular election cycle, you couldn't find two more polar opposite candidates, both in terms of their platform, their views on taxation, and the industries, frankly, that their policies favor.
I think some of the interesting data that I'm looking at here, which is from Schwab, it's a great resource, I think, as far as what are the statistics telling us, is that not only what you articulated there as far as an incumbent being kind of overthrown, or I like that, like overthrown, like they got ousted. Yes, that's how that worked. So the market performing positive in both scenarios, and it's a percentage difference in either one of those scenarios, and I think that's the backbone of what the market has given us, is this understanding that over time it will go up. Right? We have pullbacks and we have seasons and we have these places where the market is lately violent in terms of how quickly it will drop and how quickly it can come back. Over time, we have a positive outcome, more positive with the return of a seated president than the incumbent coming in, or excuse me, the new president coming in. But if you take a look at some of the other numbers there in this art, in the numbers that we have from Schwab, is that the 2 calendar years following an election, they tended to be slightly less positive. However, the average annual returns of 5.8% and 4.5% respectively. It's the 3rd calendar year after an election historically has been. That's been the juice. That's been the most fruitful, ending in a positive territory 82% of the time, with an average annual return of 13.7%. So in terms of why does the market do what it does? And the market responds really well to understanding what is going on. When the market says and takes a look around and says, we get it, we're in, it responds very well. And I think that's one of the things that third year can typically do or give us, as far as that reflection on how does the market respond to whatever's going on around us. As long as it knows what's going on, it's going to do well.
I think key to that point, Seth, is really the one instance where there is concern following an election is if, in fact, it's been a disputed election. And Ben alluded to the fact that we've heard from both parties some potential elements of how they intend to behave, depending upon which way this thing goes. But in the year 2000, if you recall, there was some dispute around the mail-in ballots and how things went down in Florida, and that suspended the result for a little bit of time. And the effect that had is, in fact, the S&P was down 6% in those first 2 weeks following the election, and the Dow was down 5% in that same 2-week period. Now, after that, when the election was decided, volatility settled out. But for the year, the S&P remained down 9%.
Yeah, I mean, a disputed election scenario is a real problem for our country. I mean, there's just no two ways about it. I think the thing that I look at inside this whole piece is just trying to understand the overall odds of what the market looks like, right? Because we're not voting, we're not investing based on one vote. We're investing based on long-term statistics, likelihood of how the economy is going to move forward. We talk about the pandemic. We talk about technology. How does that look like? What does that play into our future? And, the one statistic in that Schwab article that we have here is 17 of the past 23 presidential elections years, 74% of the time, essentially, the market is up during the election year. And the average is about 7.1%. Which is very positive. It doesn't even matter what happens on the outcome. 74% of the time, the market's positive during the election year. And when the election happens in November, right, we still have almost 2 full months of the remaining year. So that gives some good exposure for people who are, very concerned about how the election came out to move their money out and cause, tremendous downturn. But that doesn't seem to happen the majority of the time. And I think that's a pretty good indicator that just the election itself is not a long-term decision factor for a lot of investors. I also think that when you look at the preceding years that this article talks about, it brings together a couple of really interesting points. One of them is that in the year following the election, and then the next following year, as Seth had mentioned, that 5.8% or 4.5% returns, that is still happening the majority of the time. We're still having positive returns no matter what the scenario is long term, which is continuing to show that upward progress and movement. I think the one piece that just really says to me, man, I really got to get my money in, is that year 3. That third year, right before that election year, is when the market just seems to just 82% of the time, it's up on an average of over 13%.
Yeah, and speaking about that third year following the election, and keep in mind what else is going on, the midterm Senate elections would have just taken place. So from a regulatory perspective and for corporations that make up the economy, they have a pretty good handle on, at least for that 12-month period, what the lay of the land looks like.
Yeah, that's exactly right on. I mean, that's the piece of the election that, the markets, as an average investor, a lot of people say to me, like, I just don't know what's going to happen or how this is going to play out. But the truth is that the big companies have all these things running in the background of every software program they have, right? And they know the midterms, they know what an incumbent will do or this, that, or the other thing. But there's a lot of They generally know, hey, listen, this is what we have to be prepared for, and this is how we're going to hedge it.
So one of the questions I had, Dan, was this. You talked about the 2000 election, and if I'm trying to remember who was running against Bush at that time. Do you remember?
That was Gore, Al Gore.
Yeah.
Oh, right. Okay. So, that's right. It was Gore. Vice President Gore was running against Bush. So there was a dispute at that time, right? What else happened in the year 2000? Tech bubble.
That's an interesting correlation.
Yes, and I think we have something in likeness and trying to get likeness to likeness here with the coronavirus and potentially an election kerfuffle or debacle with the nobody being able to get to the polls to poll in person. Now, I can't tell you the last, and plus there's the mail-in ballots being as slow as possible at the moment too. But can we tell or read into this one direction or another what's going to happen? And the answer, I think, is no, we don't. And you gave us some great data there that supported potentially what we could look at in the short term. The question I think that we first want to ask is, are we going to invest? Are we investors? Are we long-term or are we short-term investors? And I think the data that really supports the what we would say is that yes, yes, I mean, historically, you're looking at roughly a 5% return, which is, do you want that or not? Or do you just wait around? Do you have another place where you're going to get that? Okay, great. Go get it. Are you just waiting around for that third year? For the average, 82% of the time, that average of 13%, 13.7%? No, we're long term in this whole thing. And so I think the question that we always want to come back to is, yes, we're going to continue with our plan, which is supported by the data, and we're going to continue to invest. One of the things that I come back to as well is, do you remember the last election? What happened like the night of, or the day of?
Oh, I remember.
Was that intense?
Yeah, the market crashed overnight over like almost 1,000 points, which doesn't sound like a lot anymore, right? Because the market's just all over the place. But I mean, in the last 6 months, 1,000 point move is like, oh, it moved 1,000 points, But overnight, it was down, I think, 900 and change that night. Rebounded and was positive. I was 500 or 600 or another 900. I can't remember. It was almost a 2,000 point swing or 1,500 point swing, right?
It's funny, when I was getting ready for the show and doing a little bit of research on some of the talking points we'd use today, I ran across an article from 2016, and I forget the source of it, but it was it was right at the top in Google, so you think it might have been a worthy publication. But the analyst there said he predicts with 100% certainty a 50% drop in the market if Trump wins.
Wow.
Interesting, right?
That's huge. And I think it was interesting, like what you said, Ben, that 1,000-point drop at that time.
That was when the news was saying Hillary won.
Yeah.
I mean, that was when the market was dropped. As soon as the swing happened with Trump was winning, the market had that full recovery. But that's a very scary statement. And we've alluded to that a little bit in the conversation of what would happen to the market if Trump wins, because what we've seen with the riots right now, it's like, I mean, there's protesters and there's rioters. I don't have a lot of respect for rioters. Protesters execute with inside the law. I'm totally fine with it. But I just think that the rioters I think this gets bad. I think people get very fearful what's going to happen to these cities. I mean, Seth, you're over by Portland. I mean, I'm hearing people say that Portland and Seattle are, probably 20 to 30 year recovery plans now. I don't know if that's true, but that's a scary incident now. If we have massive riots, I mean, cities generate more jobs than anywhere else in our country. I was listening to this on the news yesterday, actually, and we need to be champions of our cities because they are the ones that provide a lot of jobs. I mean, between waiters and waitresses and people cleaning bathrooms, or the hotels, or there's just so many jobs in our cities. And as the cities get destroyed and people flee the cities, the jobs drop drastically. And that's a huge issue for our long-term employment issues. And, one person was saying that, New York is really in a tough spot. And Jerry Seinfeld was actually criticizing the guy. And I was listening to all of this, but just the point that if we have Trump reelected and it does cause crazy riots and destroys more of our cities, it just creates a longer recovery time for us as a country.
Yeah, that service work. I mean, there's a lot of things that you can do remotely, but service work isn't really one of them. You need to be present. You need to be there, taking care of your customers, and the impact there. If there truly is that flight from cities and the retail world in general, I mean, it's just scary what that impact could be.
Yeah, there's a lot on the ropes for sure. I mean, travel doesn't happen without moving across the country. They haven't figured out how to solve that one for us yet, or across, global spots. I mean, geez, you want to go to Hawaii? Good luck.
Have you taken your first virtual vacation yet, Seth?
Oh, Lord, we need help. So one of the statistics, I'm going to move on to more numbers. One of the statistics that I thought kind of amazing, I had no idea. This one really surprised me. The total return of the S&P 500 has averaged 57.4% under Democratic presidential administrations versus 16.6% under Republicans. That's not one that's getting out there a whole lot, is it?
No, but I'm gonna allude to the fact that it's probably the Democratic benefit of the Republican work, and then it's the Republicans fixing the Democratic work. I don't know.
Yeah, you work so hard to get that pendulum swinging back the other way that by the time you finally exit office, it's well on its way.
Correct. No,
And
I'm just
enjoy
kidding.
that. Yeah.
But that's the accusation of every presidential candidate that's coming and going, right? I
Well, we
did
hear
it.
so often that Trump credits Obama for the economy, correct?
Right, yeah,
That
exactly.
seems to fit the story.
Yeah, exactly. Right. Everyone says he's benefiting from Obama's work, vice versa. So it's all the same story. But it is pretty surprising that when you have a Democratic president, I saw that too, and I was like, wow, that is a big difference: 57.4 versus 16.6. That's a big deal. I think this was probably one of the more interesting pieces. And after I do the statistics, Dan, I want to run into the sector conversation about which sectors potentially benefit, whether Trump's in office or Biden's in office. I think we can do that right after our break. But the last statistic here that's interesting is that when the S&P 500 has risen in the 3 months before an election, the incumbent party generally has gone on to win the White House. When it has fallen, the incumbent party has generally lost. And since 1928, this trend has broken just 3 times, an 87% success rate, and hasn't missed since 1980, end quote.
Very interesting.
That is a sobering conversation right there.
Folks, we have to do it. But know this, we will be right back with more Money on Tap. And as Ben talked about, we've got a lot more to uncover here. We've had some fun talking about performance and some of the correlation here with a Democratic or a Republican candidate and or an incumbent or a new candidate coming in. We're going to come right back and talk about the platforms and get down to some of the nitty-gritty here, folks. That's what it's all about. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're jumping right back into Trump versus Biden. And Dan, you've done a great job in researching sectors and how this is a big deal in either one of these scenarios moving forward.
Yeah, it's really interesting. I mean, I think we mentioned earlier that they couldn't really be more polar opposite candidates. But really, in taking a look at the sectors and in which sections of the economy and the market in general are likely to perform, it really comes down to 2 key considerations. It's taxes, it's tariffs, and then a third one is deregulation, which with Trump, I mean, I think we all understand where his platform is and will be kind of more of the same from where we're at. But if you look at it from a sector perspective, he certainly favors the fossil fuel industry, right? So oil and gas, you think would continue to perform, presuming we recover from this COVID thing and a lot of our travel industry gets back up. Financials, industrials, Trump is obviously favored trying to bring back manufacturing to the states, which boosts that industrial sector tremendously. And one of the things that's interesting too with the deregulation is that the mid cap, the kind of smaller size businesses seem to really favor that lack of regulation, and some of the things he's done has been tremendously in support of that segment of the economy. And then we look at technology, that's been generally neutral. Real estate's been neutral, and they expect that to be the future outlook as well. And then looking at Biden on the other end of the ticket, the industries that would likely rebound or see a spike given his winning the election would be Chinese stocks, right? The China stocks, which would fare better, presumably, with a little less of the tariff pressure. Clean energy, of course, with the whole green movement. He's a big supporter of that. Pharmaceuticals, healthcare, defense stocks, and utilities are all expected to rise, if he were to win and unseat Trump.
So is gold.
Gold, that's right.
Flight to safety. No, I'm just busting chops. But, it's interesting, though, that I don't think that I have seen... I think the one piece about the sector comparison here is I haven't seen a more polar sector scenario between two candidates before. Because, in previous scenarios, there would be some that would pretty much overlap as opportunities, where you might say, hey, clean energy is potentially an opportunity, or pharma is potentially an opportunity with both candidates. That would be a safe sector to move to, almost irrelevant of who gets in, right? That's kind of how the industry really looks at this stuff, especially hedge funds. They look at the overlap and say, hey, you know what? The safe plays here if we want to be in.
Yeah, really not a lot of middle ground this year. Not a lot.
Yeah, and I think that's kind of the piece in the market that makes this such a vulnerable position based on who gets elected and how your assets are invested. If you're heavy, energy, unless it's utilities, if you're oil and gas heavy because the market's been pushed down, which I like oil and gas. I'm kind of a long-term oil and gas user. I think that industry does come back as soon as, airlines come back. We've got all these future retirees that still want to do their, European vacations and take their cruises, and people want to do that once this all kind of blows over. And, that demand for the oil and gas, I think, comes back at, strong thresholds. As much, I don't know. But I don't think we're going to be where we're at today. And that's why I'm an optimist in that area. But with a Biden election, maybe that's a real problem.
Well, one thing is, the consumption there, of course, is a key driver, but regulation's another. Clearly these two candidates are on total opposite ends of the spectrum in terms of fossil fuel regulation. There's just no doubt about it.
Yeah, I agree with that. I think the one piece about it is that, year over year, this is the first year we'll have less oil consumption in the United States than any preceding year because of the pandemic and the stay-at-home orders. But even with the previous year where we still had more oil consumption as a country than we did the previous year, and we had the highest clean energy initiatives we've ever had. So more and more clean energy is getting created. But I think that speaks to the amount of oil consumption we are just absolutely dependent upon. The infrastructure has just never been strong enough. I think you make a great point about China. If more solar does come down the way, that's definitely going to push opportunities in China for infrastructure just by the creation of the panels.
Yeah, that's a subsector of the sector itself. But considering the fact that in all likelihood China will manufacture these solar panels and Americans will install them. But getting back to the point regarding gas consumption, regardless of how green an instrument it is, you still got to ship it across the ocean. You still got to load it onto a truck and drive it to where it's going.
Yeah, I was out and about, ran into this gentleman who drives a truck for a living, and we were just chatting about how crucial that industry of transportation is. Every American should be thankful for every person willing to go out and drive for us and get the stuff we need all over the country, because it just doesn't happen that way with any, even if you're loading trains to get stuff across the country, it's still going to get loaded onto a truck and get shipped somewhere. And there's a lot of oil consumption there.
Hey, I heard if you own a moving company, you get a Lamborghini. So
I like that.
Let's talk about taxes, you guys. What are some of the different? Okay, the general or the gist that I've seen is if you're making over $400,000, basically Biden is going to have some significant increases in your taxes. And the corporate tax rate is going to be going up from the 21 to 28%. Right, that's huge. That's a huge difference in the corporate tax rate. But the top tax bracket currently right now 37%, moving up to back to 39.6. And if you make over 400K, there's going to also be Social Security tax there.
Yeah, there's a ton of stuff going on as you're mentioning there, Seth. I think if I were to jump into the Trump conversation, to just kind of create a baseline of this, when Trump came in, he created a number of tax cuts, both corporate and personal. He increased the child deductions. He made them, basically they were credits. They were not just they literally came off the amount of money you owed, which was a different type of tax, which was more beneficial for the average person who had children. And basically he wants to keep these tax cuts flat. So when Obama was president, the corporate tax rate was 35%. In Trump's administration, they lowered it to 21. Okay. Pretty much Trump's remain as is. Would we all agree on that for the most part, other than the payroll short-term tax cut he's looking at?
Yeah, not a lot of changes to the platform suggested that we've seen in black and white anyway. So, yeah, I think the expectation would be, should he remain in power, that, it would the tax scenario, the lay of the land would remain the same.
I think the one thing that might change, he wants to find more stimulus. There's some level of stimulus package that is being sought after, and whether they get it through the payroll tax cut, the short-term tax cut or not, I have no idea. I'm not necessarily, I don't really have a solid pro or con opinion on that, but we had chatted about this offline about how the 2% cut they made, what was that?
2011.
Yeah. That didn't really seem to do much.
I think one of the reasons Trump has kind of struggled with this payroll tax holiday he's suggesting is really twofold. One, it further defunds Social Security, which is a major issue for all of us. And another point I thought was interesting and I saw is, really the most harmed element of our economy, the people who are unemployed. And that's not going to help them. Yeah. They don't have a paycheck.
Exactly. I agree with that. Totally. I do think that this is trying to figure out ways to help. I mean, this is really, I think what the hope here is that by doing the payroll short-term tax cut, that would reduce the employer side of the financials, that would allow them to afford potentially more employees to rehire. I think that's the hope.
Yeah, I think there's generally two directions around the stimulus, and Trump's point is to reduce the burden on small businesses in the hopes that they hire. And more Biden's platform is just send the money direct and hope people spend it.
You guys, there's a lot of moving pieces here. Kind of some takeaways. I think it's important for us to lay out not just all of the articulation of these numbers here, but just some takeaways for people that they can understand as they're going about their daily lives. What is this going to look like for us?
Well, I think the piece about with Biden and how this is going to look is that, there's basically his proposal is raising taxes on a number of different areas that will create somewhere between, and there's a number of different estimates, but I would just say between $3 and $4 trillion over the next 10 years. And that pretty much has to do with a couple of little ABCs. One is to raise the corporate tax rate from 21% to 28%. So he's not bringing it back to the Obama levels, but he's bringing it to 28. He's taking the top tax bracket, as you mentioned earlier, Seth, from that 37% to the 39.6 that it used to be. Pretty much not going to happen, not going to affect the average Joe for the most part, right? I would say this is definitely more, if you're a corporation and you're the average Joe, yeah, that would affect you a little bit. But the big piece here is the Social Security item. And I think this is the thing that some of our listeners would find completely irrelevant to them. And then some might say, wow, that's really an issue I need to address with my CPA. But one of the things is that Social Security tax on like a self-employed individual, the person, it stops at $137,000.
That's right.
Yeah, $137,000. And so if a husband and wife each make $137,000, they're both paying Social Security tax to that number. After that, they don't pay Social Security tax anymore. That's as the current tax code sits. So if a wife stays at home and a husband makes, $200,000, they're only paying Social Security tax on that first $137,000. And you'll find a lot of self-employed people won't give their spouse a paycheck because of that reason. But the move here is that Social Security tax would restart. So you'd get Social Security tax up to $137,000, and then it would restart again at $400,000.
That's right.
Now, the interesting plan here is, let's say you're a self-employed person making, $500,000, and your wife stays at home, and you're using that Social Security piece. What you might want to do is stop your income at $400,000, and then pay your wife the other $100,000 to get her Social Security credits and also get her some income level items in her Social Security benefits. That might be one piece to look at in that scenario.
Interesting take. Yeah, that would make a lot of sense.
Folks, you've heard it from Dan, you've heard it from Ben, and you've heard it from me. This is the Trump versus Biden show. It has been a lot of fun bringing some of these numbers here to you today. I cannot wait to see what happens next. It is an exciting time of our life. Dan, thanks for being here.
Appreciate it, Seth. Thanks for having me.
That's going to do it for us on Money on Tap. Make it a great week.
On this Cliff Notes edition of Money on Tap, Ben and Seth look at an all-too-familiar scam that so often targets social media.
Let me ask you a question. Have you ever clicked on an email and before you knew it, you were carried away into the ethos of the web? Before you knew it, you're in some site that is asking you for some personal financial information, and all of a sudden your alarms go off in the back that say, oh my gosh. I think I've had that experience, as a matter of fact, and then there's the fear that comes alongside of that, where you're watching and monitoring your bank accounts or your social media accounts or whatever's out there with your information on it, wondering who's now emailing all of your friends, dire straits emails telling them that you're locked up in a jail in Antarctica and need $50,000 to get out. So.
Sounds personal there, Seth.
Oh my gosh, it's the book that I'm writing right now. So not really. But anyways, if you know anybody that has an email address or has a social media account, they've probably had something that's similar to this. Okay, so
I think we've all seen some level of social media. If you're on social media, you've seen scams. Probably the most current one is the COVID, by tricking people to do something regarding it. A picture or an ad or something, help somebody. It'll be something along those lines. It's really identity theft. That's really their number one issue, is trying to grab your identity. And everything that is the core of what they're trying to do.
Yeah, there may not be an outcome just from the social media scam immediately, right? The goal usually is kind of a multi-tiered or a layered type of a scam, and the end goal is to get as much of your information as possible, right? They can then turn into some other outcome down the road, which is the ultimate of the payoff here. I'm thinking of somebody direct messaged me, right? Not somebody that I talk to on social media or frequently, but all of a sudden I've got this message that pops up.
But someone you might trust, somebody you think you trust.
Yeah. And I'm like, oh, hey, well, it's good to hear from you. Yeah. As a matter of fact, this has happened on a couple of different social media platforms to me, where they were direct messaging me, and I had to stop what I was doing. First of all, I'm a pretty social, talkative, polite person. If you're reaching out to say hi to me, unless your name's Ben Brayshaw, I might have a conversation with you. And so, but the conversation was so kind of vanilla, like not really going anywhere. I said, hey, this is my protection for myself, is just to make sure that I wasn't being rude. I just said, hey, could you tell me the last time or where we met? Something that both of us would know, right? And that was an immediate shutdown to the conversation. Clearly, it wasn't the person on the other end. It was somebody that they had gotten hacked or whatever. But that was an attempt right there to go ahead and get information from me. And it really did look very legitimate. So it was not something that posed an immediate threat to me, but it was the process of building that towards that end where it could land like that.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning.
Thanks for joining us today. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, we're in a podcast. You can find us at any of the podcast venues out there. We appreciate the likes and the listens. We're also at Facebook at /3D Investing and Twitter at BFG_LLC. Thanks for joining us with Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.